Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special housing report brought to you in association with the BNZ. Today I want to look at funding costs for banks and a report that's come out of KPMG called the Financial Institutions Report. It's called FIPS, and it's a good indicator of what's happening in the overall banking sector and what might happen to interest rates in the next year or so. It's clear from the FIPS report and from what's happening with the Reserve Bank and the banks that the bank's funding costs, how much it costs them to borrow their money before they lend it to us, how much that's actually increasing over the last year or so. Now there's a good reason for this. The Reserve Bank has asked the banks to make sure that more of their funding comes from secure long-term sources. Now that can come from a foreign bond issue, long-term bond issue, or from mums and dads here in the form of term deposits. Less of their funding can come from the hot money markets, the so-called wholesale financial markets, in the form of short-term borrowing. That's because during the financial crisis at the end of 2008, those markets froze up, which really concerned the Reserve Bank and, of course, all the banks. Now, this core funding ratio policy the Reserve Bank have put in the last year has effectively increased the cost of funding for people who are borrowing, mortgages in particular, by around about 100 to 150 basis points, according to KPMG in its FIPS report. The question is, over the next year or two, what's going to happen to funding costs and to mortgage rates? It's clear from KPMG. They expect the increase that's coming over the next couple of years in the core funding ratio from 65% to 75% is going to increase the cost of funding for banks. That's going to be passed on to people in the form of higher mortgage rates and higher term deposit rates. Now that's obviously going to put some downward pressure on the housing market over the next year or two as the Reserve Bank increases its official cash rate, the base of interest rates, and banks have to put on this extra funding cost that comes because the Reserve Bank, rightly I think, is asking them to make sure more of their money comes from long-term, secure local sources. I'm Bernard Hickey. That was a special housing report brought to you in association with the BNZ.